Well, hello there. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
Welcome. Today, we will conduct a detailed examination of managerial accounting. Now, this is a critical function within any modern organization, and it's so much more than just bookkeeping. We're talking about the part of accounting that helps shape the future, not just report on the past.
So our analysis will proceed through 5 distinct sections. We'll begin with a formal definition, then explore its scope and application. After that, we'll draw a really important comparison to its counterpart, financial accounting, highlighting 5 key distinctions. And finally, we'll bring it all together to understand its relevance in actual decision-making.
First, let's establish a precise academic definition for our subject. What exactly are we talking about when we say managerial accounting? All right, so here's the textbook definition. It's a field of accounting that provides economic and financial information for managers and other internal users. Now that last part, internal users, that's the key term here. It's really the foundational characteristic that distinguishes it from other accounting disciplines. Everything else we discuss today is going to stem from this one core idea.
Now, it's also really important to note that the role of the managerial accountant has evolved significantly. In the past, they were seen as simple record keepers, primarily focused on collecting costs and reporting what had already happened. But today, it's a whole different ballgame. They're strategic partners within the enterprise. They're evaluating how resources are being used, providing critical data to cross-functional teams, and they're responsible for strategic cost management. They've gone from being historians to being architects of the future.
Okay, now that we have a solid definition, let's explore the breadth of its application. Where exactly does managerial accounting fit into the economic landscape?
And the answer is everywhere. The principles of managerial accounting are not confined to a single industry or a specific organizational structure. No, they are universally applicable. It doesn't matter if we're talking about service, merchandising, or manufacturing businesses. It doesn't matter if it's a sole proprietorship, a partnership, or a massive corporation. And it doesn't even matter if it's a for-profit enterprise or a not-for-profit entity. The need for internal, decision-focused information is truly universal.
All right, to fully appreciate managerial accounting, I think it's essential that we compare it to its more publicly known counterpart, financial accounting. This comparison is really going to highlight what makes it unique.
And let's be clear, both disciplines are rooted in the same fundamental task. They both quantify and communicate the economic events of a business. They share that common DNA.
However, and this is a big however, their objectives, their audiences, and their outputs are fundamentally different. So the crucial question is, how? This divergence in their methodologies and purposes is where the critical distinctions lie. And this brings us to a crucial points of comparison. Right now, we're going to deconstruct the 5 principal differences between these two fields.
Now, this table provides a comprehensive overview of the core distinctions. You can see them lined up here. Primary users, report frequency, purpose, content, and verification. We're going to examine each of these individually and in greater detail now.
Let's start with the first distinction, the primary users. This is, without a doubt, the most significant distinction. Managerial accounting looks inward. It serves internal decision-makers like officers and department managers. In stark contrast, financial accounting looks outward, serving external parties like investors, creditors, and regulatory agencies.
Next, let's consider report frequency. This difference in timing directly reflects the different needs of their users. For managerial accounting, reports are generated as frequently as needed to facilitate timely decisions. Think daily, weekly, whatever management requires. Financial accounting, on the other hand, operates on a fixed, periodic schedule, typically quarterly or annually, to meet the structured reporting requirements of those external stakeholders. The third distinction is the purpose of the reports themselves. Managerial reports are created for a special purpose, tailored to a very specific decision at hand. Financial reports, by contrast, are general purpose. They're designed to provide a broad overview of the company's overall financial health for wide consumption. So you can think of managerial reports as being highly customized, whereas financial reports are standardized. Naturally, this leads us to our fourth distinction, the content of the reports. The scope of the content differs dramatically. Managerial accounting content is highly detailed, it often focuses on specific subunits of the organization, and it may even include non-financial data if it's relevant. Financial accounting content is aggregated.
It pertains to the entire business and must follow specific, generally accepted accounting principles. So, we're looking at a micro-level focus versus a macro-level view.
And finally, our fifth distinction, the verification process. Here again, the two are quite distinct. Managerial accounting data is not subject to an independent audit. Its value lies entirely in its utility for decision-making. Financial accounting data, because it's for external users who rely on its accuracy, must be independently audited to ensure that accuracy and compliance. This reflects the internal, informal nature of one versus the formal, regulated nature of the other.
All right, let's now synthesize these points to understand the ultimate objective, the true purpose of managerial accounting.
This singular phrase from our source material perfectly encapsulates the guiding principle of the entire field. The standard is relevance to decisions. That's it. While financial accounting is governed by a strict set of rules, managerial accounting is guided by one core question. Is this information relevant to the decision that needs to be made?
And this is the ultimate function. It's a chain of events. First, you provide the information. Second, that information informs specific decisions. Third, those decisions guide internal strategy. And fourth, that strategy is what drives organizational performance. This is the critical takeaway. Unlike financial accounting's role of reporting past performance, managerial accounting's purpose is to actively shape the future of the organization.
And so, we conclude by posing this question to underscore its value. What critical business decisions, from something like product pricing all the way to market entry, would be impossible without this internal, forward-looking focus? Think about it. Without this data, these choices become guesswork. Managerial accounting, therefore, isn't just a support function. It is the indispensable strategic engine within any successful enterprise.